Oh my god, Netflix stock is soaring 13.5% in the after hours after reporting their Q4 results. What is causing shares to soar in the after hours? Well, spoiler alert, it's an absolutely sensational quarter where they're once again accelerating revenue growth, accelerating profit growth, accelerating membership growth in all facets. And it really all comes down to the content slate and the execution over at Netflix. We have to dive into this Q4 print. And speaking of diving into, we have to take a look at it from a technical perspective. The stock is going nearly off the charts and basically is defying gravity. We have to take a look at it from a technical perspective as well. Hey guys, hope you're doing well out there. It's time to jump into shares of Netflix, as this is the first of the mega cap FANG stocks reporting, and the only one reporting this week. Will get more earnings from other mega cap names next week. But look, shares of Netflix up 81% over the past 1 year, have basically outperformed every other mega cap stock other than maybe Nvidia and possibly Tesla, and that is for good reason, because the company is firing on all cylinders. Revenues in this most recent Q4 came in at $10.25 billion. That was good for 16% growth year over year. Guys, to put that in perspective, Wall Street was estimating nearly 14% growth. And again, the most bullish analyst on Wall Street was projecting 10.27 billion. Netflix coming in just shy of that expectations at $10.5 billion. The really important figure though is the global streaming paid memberships. That came in at a growth of 18.9 million net new paid additions, crossing now 300 million net paid members. Guys, to put that into perspective, expectations were for a gain of nearly 9 million net paid additions. Netflix more than doubling that by adding 18.9 million net paid subscribers over the past quarter. That is a growth of nearly 44% year over year. Again, for a company that's massive at $366 billion, still growing at nearly 44% from a paid membership perspective is just absolutely phenomenal. So right there, you can absolutely tell why shares are soaring nearly 13% in the after hours. The other reason is you got guidance that fell relatively in line with consensus estimates for the current Q1, but they did exceed expectations for the full year of 2025. So for the current quarter we're in, Netflix is expecting revenue of $10.42 billion. That comes in just shy of the expectations of 10.48. They're also coming in underneath expectations on the earnings side of $5.58, expectations closer to $6. But keep in mind, they are still expecting a very solid 2025 with now revenue expectations of $43.5 up to $44.5 billion for the full year. That is a raise from their prior guidance. They're also raising guidance on the operating margin side for the full year. They did mention that they are expecting some negative impact on their 2025 revenues from a foreign exchange headwinds. Keep in mind the US dollar has been particularly strong over the past couple of months, and that does affect a company like this that tends to do business across different geographies. We'll talk more about that when we get to the regional breakdown. But look, from their shareholder letter, they outline one sentence that pretty much describes the phenomenal quarter over at Netflix. In Q4, our slate outperformed even our high expectations. Squid Game Season 2 is on track to become one of the most watched original series seasons. Carry On joined our top 10 all-time films, and the Jake Paul-Mike Tyson fight became the most streamed sporting event ever. Also, you had the 2 NFL Christmas Day games that delivered the most streamed NFL games in history. So right there, that tells you why this company had such a phenomenal Q4. In fact, when we're taking a look at the press releases over at Netflix, it should really have come as no surprise considering the content slate Netflix was set to deliver in Q4. Of course, you had Squid Game Season 2, which, if it was anything like as popular as the first Squid Games, would be a wild success. On top of that, you had the Jake Paul and Mike Tyson fight. You also, I think more specifically, had the NFL Christmas Day games, which drew in a record average 24 million viewers for each of those Christmas Day games. And keep in mind, that demographic is pretty young, from 18-year-olds to 34-year-olds, the majority of that demographic. So a lot of those people will likely continue to stay on their Netflix subscription and continue to renew it. And especially if Netflix continues the push into live sports and live streaming, yeah, a lot of that demographic will simply just continue to renew their Netflix membership because they see enough value for it. And looking ahead, they do still expect to broadcast a NFL Christmas Day game in 2025 along with 2026, and then they also have plans for more live sports in 2027, 2031, with the Women's World Cup. So Netflix certainly is doubling down on live sports. I think they saw it when they streamed the Jake Paul-Mike Tyson fight, and even though they had technical issues with that, they saw the wild success that was. They worked out those technical issues, and yeah, well, needless to say, the NFL Christmas Day games were an absolutely wild success over at Netflix, and I think they figured something out. The push into live sports and live streaming is absolutely the right move to make for this company at this current time. Now, from a regional breakdown in terms of net paid additions, the two most important regions, United States and Canada, along with Europe, saw a massive acceleration in net paid additions. You added nearly 5 million net paid ads in each of those regions. Just a quarter ago in Q3, they added less than 1 million net paid ads in United States and Canada, and just 2 million ads in Europe. So you're seeing that massive reacceleration, not just quarter over quarter in net new paid additions, but also year over year. You look back to Q4 of 2023, they didn't add nearly as many net paid additions. Again, a lot of these are probably also on the advertising tier side, and so maybe they aren't charging as much for the average revenue per membership there, but they're still seeing those net paid additions, and maybe down the road, some of those will convert into the ad-free tier over at Netflix. You're also seeing continued growth in the average revenue per member, especially in United States and Canada. You added nearly 4% on your average revenue per member, now crossing $17.26. You're seeing a bit of a struggle there on the other regions, especially Europe and Latin America. Keep in mind, you are seeing foreign exchange headwinds, and so when you strip those out, when you make it foreign exchange neutral, you are still seeing growth in those regions. And then when it comes to Asia, you're basically seeing flat to declining growth on the average revenue per member side, considering the fact that that's a market where you've probably tapped out on how much you can go up on price, but you're still seeing net paid ads continue to increase, again, nearly adding 5 million net new paid ads in the Asia Pacific region. So all things considered, you crossed the 300 million global streaming paid memberships mark for the first time in this company's history, and you significantly accelerated your year-over-year growth up to nearly 16%. And keep in mind, this was the last quarter where Netflix will point out these numbers from a net paid additions, also from an average revenue per membership. Moving into Q1 of this year, they'll stop reporting that, I think for a couple of reasons. One, they just don't want as much volatility, as much scrutiny on the subscriber count itself, because I think they've said in the past it's not really an indication of this company moving forward. I think they're focusing more so on the engagement and the time spent by members watching some of their programs. I think that's what they want to focus more so on. They also want to become more profitable and focus more so on the bottom line. So for various reasons, but I think in 2024, investors really came to realize that it doesn't matter if this company reports those net paid additions or not. They'll simply continue to execute like they have for the past 4 to 5 quarters. They've been growing nearly 16% year over year on those global streaming paid memberships, and certainly I expect them to continue to do that. The slate of content in 2025 for Netflix continues to be really strong. They of course have Squid Games. They, I believe, also have Stranger Things coming out sometime in 2025, which again, if it's as successful as the previous seasons, it'll be nothing short of spectacular. So those figures like the revenue and the net paid ads really tell you the strength in the underlying business, the strength in the demand for Netflix's content, and that continues to certainly be there. What the financials will tell you is how efficiently this company is now looking to run and how efficiently they're looking to control those costs. So you see $10.2 billion in top line revenue. Like we said, that was 16% growth from same time last year, where you were closer to $8.8 billion on your top line. Your cost of those revenues did rise from 5.3 up to, call it, $5.8 billion. Keep in mind, this was their Q4, so their cost of revenues on the content side, also on the sales and marketing side, tends to be a little bit more inflated because this is the holiday time period. A lot of new people will likely come onto the platform, and so that content slate, along with the sales and marketing, tends to be a bit more bolstered for the Q4. You also saw your tech R&D went from 670 million up to, call it, 770 million. So they are still spending on technology and development. Some of this, I'd say, is certainly expected as you grow in scale and your server costs continue to increase, but a lot of it is probably related to AI spend that they're now infusing into their platform. Certainly those recommendation systems, similar to how Meta does for those Reels and Facebook and Instagram does. I think Netflix has a fantastic recommendation system. That's one of the reasons why you see users continue to sign up and continue to stay on and watch their content. you saw your G&A costs stay relatively in line from 430 up to call it $450 million. And so your total operating income went from 1.5, call it up to $2.3 billion in the most recent quarter. For the last year, for the last 12 months, you went from basically $7 billion up to $10.5 billion in operating income. That is fantastic growth year over year. On top of that, you're seeing this company continue to buy back shares. And so over the past year, they bought roughly 8 to 9 million shares outstanding. And so you're seeing that EPS and that net income continue to grow faster than your operating income. But all things looking absolutely stellar from the P&L statement. From the balance sheet, looks pretty solid as you have $7.8 billion in cash and cash equivalents. That did increase meaningfully from same time a year ago, roughly up call it 10%. The vast majority of their their assets lie in this content assets line at nearly $32.5 billion. This is really the moat around this business. This is why I would consider Netflix a very, very dominant and special business, because there's not many other companies out there. In fact, there's no other streaming company out there that can replicate this sort of content assets. This is similar to how in TSM, we give their property, plant, and equipment the real value and moat, because there's no other semiconductor company out there that can manufacture those sort of fabs. Similarly, on the streaming side, there's no other company out there that can replicate what Netflix has in terms of content assets. From a liabilities perspective, they have roughly $1.8 billion in short-term debt. You add on another 13, call it $14 billion in long-term debt. And so you're looking at north of, call it $15 to $16 billion in total debt. Now, keep in mind, that is something this company can afford because they're generating close to $1.5 billion a quarter in terms of operating cash flows. For the full year, you generated close to $7.4 billion in operating cash flows. They do spend a little bit on property and equipment. They also did do a purchase of an investment to the tune of roughly $1.7 billion earlier in the year. But again, the vast majority of those operating cash flows are spent buying back the stock to the tune of close to $1 billion, which was a slowdown from a quarter ago. Keep in mind, the stock has absolutely rocketed up, especially a slowdown from a year ago where they bought back close to $2.5 billion worth of their shares. And so as shares continue to move up, Netflix still is buying back shares, but they're easing off on the pace of that buyback. And I certainly wouldn't blame them because, again, these shares have absolutely defied gravity, pretty much gone parabolic. Now, you are testing a top end resistance from a technical perspective. This company has been channeling a higher really since April of 2022. Once it saw that huge nearly 70% drawdown, it's been steadily moving higher, making a pattern of higher highs and higher lows. I had dissected this channel in half with this light green line, and we were coming down to it, but we found footing at the $830 mark prior to actually hitting that light green line. And you could actually make a case that you're starting another uptrend, which is a bit more steeper than your current one. Now, the important thing to note is at a time like this, if you don't own shares already in Netflix, it's easy to feel like you're missing out on the train. It's easy to feel FOMO'd into this one. But what I would do is actually be patient with this. You certainly will see pullbacks in the stock like you just saw over the past month. You'll continue to see those incremental pullbacks every now and then, and occasionally you'll get deeper pullbacks where you come back to the middle end of the range, if not the bottom end of the range. And those are your times, in my opinion, to step in and be a buyer in shares of Netflix. When that is occurring, the news certainly won't be pretty. In fact, there's going to be some dark clouds around Netflix saying that maybe the uptrend is over. But that is why you have to make those decisions now. You have to have high conviction that when you see those pullbacks, you absolutely step in and be a buyer, because this is a fantastic company that is executing and is likely to continue to execute. In the near term, you could see some further momentum and possible higher highs and even a breakout of this uptrending channel, considering the fact that you've already broken through your all-time highs well over $930 a share. And so maybe you continue to move up higher, crossing your $1,000 mark, but eventually you will see those pullbacks in shares of Netflix. And when those pullbacks come, you have to stay ready and be a buyer in a name like this. Because again, if you've done that over the past 2 years, in fact, if you did that anytime over the past, call it decade with shares of Netflix, that is why you've made huge sums of money. That is why you've continued to outperform the market with this one time and time again. That was my take on shares of Netflix, a fantastic company with another stellar quarter. I would be a bit careful of stepping in at this point and try not to feel FOMO'd in. You absolutely could continue to move up, but I would actually be more patient, wait for those pullbacks, let the price action come to you and step in to buy at that point. Let me know your thoughts on this one in the comment section below. Maybe in these subsequent quarters, we also get the news from a stock split perspective, considering shares are close to that $1,000 mark. I wouldn't be surprised if Netflix does tend to announce that over the next few quarters. Again, let me know your thoughts on this one in the comment section below. Congrats to anyone that has held shares of Netflix over the past. As always, thanks so much for listening, and I'll catch you guys in the next video.